morning to you. Good
morning.
Afternoon, good evening, what the case may be to the audience. It's always difficult these days to figure it out. Where are you joining us from?
I'm in southern England, in Sussex. It's not too cold.
Not too cold, but subject to the British.
Very wet.
Subject to the British lockdown. Let's start on the light side. If you had to make an estimate in current circumstances, how much would your personal oil and gas consumption have been reduced the last few days under the lockdown?
Well, my heating bill has gone up, but my transport bill has definitely declined to zero, almost zero.
Yeah, similar here from Germany, where I call. This is the European session. But we are asked to discuss the global oil markets, not our own circumstances. And global oil markets are in a peculiar situation, as you know. We have, of course, seen this massive hit to demand when the first round of lockdowns first came. We have seen the emergency meeting in April brokered by the US administration, bringing the OPEC Plus together again. And we have seen a 2-year plan for cuts in production. And I think it's fair to say that since then, we have seen an amazing and astonishing degree of discipline in sticking to that plan, and in some instances even exceeding it. Sir Mark, going forward and concentrating on the short term, when you look at this success, which resulted now in prices north of $55, will it not wake up the private producers who have not been part of those lockdowns, in particular the US shale producers? And do you think oil demand has improved in lockstep for enough to make space to allow production from both OPEC Plus and shale producers, private producers, at current prices over the course of the month?
Christof, I think we're at a bit of a turning point, which I think has been coming for a number of years. Oil is a very unusual commodity. It, unlike most commodities, in most commodities, iron ore, copper, nickel, and so on, the major low-cost producers dominate the market, and the higher cost producers pick up the tail end. And they tend to be quite well-managed markets. Now, in oil, we've had a managed market, but it's been managed by the low-cost producers, restraining their demand to keep the prices up. And that works very well if demand continues to grow. But sooner or later, if demand flattens or stops growing continuously and reliably, there has to be a change, I think, because you can't go on restraining production as OPEC has done for 45 years now. And I think the drastic drop in demand brought on by COVID has brought forward this potential change. So I think the low-cost producers are now in a challenging position. Do they want to continue with the restraining production in flat demand, which means losing market share? Previously, they were happy to lose market share as long as the price was high and the total market was growing. So although they lost share, their production could climb a little bit and the prices kept well in line with inflation. That's going to stop, I think, and it's a challenging moment for the low-cost producers.
I think that is an extremely important topic, and an extremely important topic which is underappreciated, in particular for the long-term consequences, and we'll come to that in a second. But let's approach it from today's point of view. I'll take it that you believe that demand has not kept pace with the combined power to produce oil from the private sector at these prices and from OPEC Plus when they loosen discipline.
Oh, absolutely not. And I think as prices go much above 50, as you put it, it will waken up demand. Certainly, shale demand in the shale production it will waken up shale production in the States. there is a little bit of a green light because, or an amber light, because of course the international oil companies have cut back radically on their investment in conventional oil. So there's no doubt that conventional oil has globally been underinvested in, and that does provide space for the low-cost producers to produce into the decline gap as conventional production declines. Not that it need to decline. At the right price, it can go on growing for another 100 years. But if the demand flattens, you get into this fix that I'm talking about.
So that gives rise to two questions for the short term, if we stick with 21, 22 for a second, before going to the big topics.
Yeah.
One would be, are we entering a world in which demand is so slow that prices will be kept low, and so the recovery is going to be very sluggish within the next 2 years? Or are we entering a world in which investment has been so low, in particular private sector investment, that this famous investment gap, which always makes its rounds through the commentaries and literature when prices fall, that this time it actually materializes because the hit was so much stronger than anything we have seen before? Which one of the two you think is more likely?
I think there is a chance that in maybe not in the next 2 years, 3 years or so, that there will be a supply shortfall arising from that drastic cut in investment, which continues to this day. I mean, investment in conventional oil is low at the moment. So I think there is a possibility, and that could lead to a price spike, but it could also lead to the low-cost producers using their spare capacity to bump up their market share, which I think would be a wise thing to do.
Which, from what you said, will still be ample at that time when it happens. So
I think recovery will be slower than we think. It's difficult, and we heard from the session just now about possible recovery, transport, and so on. But the world is a very big place, and OECD oil demand has been declining for quite a while, and it's been offset by the growth in China and the developing economies. And while China may be okay, I think the rest of the world has suffered wickedly from COVID, and I'm not sure that their recovery will be very rapid. So I think that will have a dampening of short-term demand. So I'm not optimistic about demand coming back rapidly over the next 2-3 years.
You're already walking down the right path, because of course I have to ask you the question I think everybody else has been asked before, which is, with your outlook on demand, with the fact that actually demand in the European Union, believe it or not, in today's countries of the European Union, has peaked in '79, OECD demand in 2005, as you mentioned, compensated for by Asia. Do you see a demand peak over the next few years? Do you want to comment on that, or is it just too uncertain to comment on?
No, I do see a demand peak. I am of this. I've always been of the school of thought that my colleagues in the industry generally, they all accept that there will be a demand peak, but they put it sometimes decades ahead. And then you've gradually seen people coming back to saying, no, it'll be in the 30s. And then people saying, well, maybe in the 20s. And I am certainly in the 20s, that demand will peak in the 20s. In fact, I sometimes think it may have peaked already.
That was my next question. May have peaked in 2019?
Yes.
Yeah.
But
okay.
But let's face it, there's not a huge difference between demand is a difference between two very big numbers, and that's always difficult to predict. And whether demand grows at a few 100,000 barrels a day or drops a little bit, I don't think it's going to collapse. I think it will be flat for a very long time. But I don't think it makes much difference to the big picture, whether it climbs, you know, 1 million or 2 for the next few years, or it declines, stays more or less flat. The macroeconomic thing is more or less the same, flat demand.
So let's go to then what does matter in this picture, which is if we agree that demand will peak soon, may have peaked already, and that it more likely to look like a plateau and a general soft decline, we can agree on all of that. You're very well known for having drawn out the consequences of that happening in terms of the configuration of the oil market. And now I would like to come what you said earlier. What are the implications for low-cost producers on one hand, for associations, organizations, cartels, whatever we call them, like OPEC, OPEC Plus on the other hand, and for private producers finally? How does the market change? Why do you think this plateau or this peak demand plays such an important role?
Well, when demand is flat, the low-cost producers cannot simply continue cutting their production in order to make space for high-cost producers. That happened, if you go back over the last 45 years, it happened. It's what saved the North Sea, brought on the North Sea, North Slope, Alaska, Gulf of Mexico, deep water, and more recently, shale. And that works fine if demand is growing, and the low-cost producers might lose market share, but their total volumes go up and they're well served by the price. And I think that's the fix that the low-cost producers are in. Now, they have very wisely, I think, invested in spare capacity so that at moments where the prices are high, they can fill the gap and grow their market share. Saudi Arabia has done that quite successfully recently, although now we see them cutting back by 1 million barrels a day. So today's situation, you can look at it in a couple of ways. Is it just the old picture continuing to play, or will there actually be a change? I personally think that there has to be a change, and that's very difficult to achieve because the low-cost producers in general, particularly Saudi Arabia, have major budgetary demands. So it's difficult to, the challenge of investing in additional capacity, which can easily be done in the Emirates or in Saudi Arabia, is that it costs money. And those low-cost producers have other demands on their cash, and therefore the production side is cash flow constrained.
So this, I think, is incredibly important point, which you have reiterated many times. So I want to dwell on it a little bit to make it very clear how these mechanics will work, which will change the market. I would agree with that. So we used to have, you're saying, and correct me if I'm wrong, a situation in which low-cost producers could cut production that would bring prices up and benefit their revenues. That's why they did it. They would lose market share because that gave a free ride to the North Sea, to the Alaska slope, maybe to Brazil, certainly to shale. But they didn't care about market share because in a growing market, over time, the volumes they had cut were clawed back by growing demand. And at some point, the system was in balance again, prices came down again, and then a next round of these OPEC cycles would start. And what you're saying is the moment the market stops growing, producers, in order to just sell the same volumes as before, will have to take away market share from somebody else. That's the definition of shrinking market. And that, if I understand you correctly, will bring prices down and result in price competition.
Not necessarily. The previous model, as you said, was that the low-cost producers were generally happy with the volume that they produced. Volume was important. You produced 7, 8, whatever figure 2, 3, 4 million barrels a day, whatever figure they picked on, they tended to be reasonably happy with it, in spite of the fact that perhaps their market their share of the market was shrinking. I don't think it's necessary that prices will come down. I think there is because of production decline in, let's put shale, call it 10 million barrels a day, on it, that's 10% of the market. Put that on one side for a moment, whether it's growing or not. What is probably not growing is investment in major conventional projects. The international oil companies are short of cash. They have cut back on that investment. They will invest, but not to the extent they have in the past. So I think conventional investment in conventional oil will flatten and will not necessarily grow unless oil prices go very high and people begin to believe in $60, $70, $80 oil, in which case we're back into the old game, which I hope will not happen.
But isn't there more flexibility, in particular on part of these private producers? So I agree with the thought experiment. Let's put shale to one side. Let's put the political constraints of the energy transition, which may cause the shales, BPs, or even Exxons of this world to limit oil production. Let's also put that to one side, just concentrate on the oil market question. Isn't it the case that in oil markets, costs always follow prices with a lag, but that these companies have been declared dead so many times and have always managed to bring costs in line with a low price environment, so that actually their returns to capital, if I remember this correctly, were very similar at oil prices of $20 than they were at $120 over the longer term. And wouldn't that indicate that this investment gap, again, as happened before, will not materialize?
Well, that's certainly very true. I think the market and the world has tended to ignore the inevitable impact of technology. The inevitable impact of technology, of course, doesn't only apply to the oil industry, it applies to alternative energies as well. We've seen that even more dramatically. So the renewable energy guys forget that same technology is applicable to oil and gas, but the oil and gas guys sometimes don't appreciate the speed at which it's happened in alternative energies. So I think it will be there. But it's a question of willingness and where companies are going to be putting their money. And if you are faced as knowing that as an international investor, knowing that there is a bunch of really low cost investment not available to you, you're always going to have a little few butterflies in your stomach as to what these guys are going to do. I mean, in a sense, it's irrational from a global point of view, the present system of low-cost producers constraining supply. You know, the world would be better if the low-cost producers actually did dominate the market. There would be a geopolitical consequence, of course, but that's another matter.
Are you aware of any other market functioning like the current oil market? You worked in the mining industry, you worked in gold, you have vast...
The mining industry certainly doesn't work like it. The mining industry I think, has a lot of lessons to teach the oil and gas industry, and vice versa. The mining industry never got around to production sharing contracts, which has got them into a lot of trouble. So no, I'm not. The mining industry, the difference is, I mean, shale is a bit more like mining, that the operating costs and the ongoing costs are higher, whereas conventional oil has extremely low ongoing production costs. Once it's on stream, it's on stream.
Yeah, so it will be difficult to find something, but let's continue the thought experiment, widen the time horizon even further. So we may not agree on the investment gap, but if it happens, it will probably be temporary. Let's think about a future in which the low-cost producers, as you say, are actually doing what they're supposed to be doing, and the rest is supplemented by more expensive producers. That raises two questions immediately. One, which you already pointed at, how do you think the current low-cost producers, in particular the GCC countries and probably also Russia, how well prepared are they for that cut in revenues, which lower prices would mean? And secondly, also of interest, I think, what would be the consequences in your view on the energy transition when renewables all of a sudden have to compete with a large segment of fossil fuels, oil, and to some extent perhaps gas, which has become much cheaper, much more predictable than before?
I think question one, I don't think that the low-cost producers are, well, whether they're prepared or not, I don't think they have necessarily a long-term strategy to get to the position they need to be in. It's going to take some pain, and they are short of cash. Personally, if I rule the world, and you may be glad I don't,
hope not. I hope I don't have to be glad you don't.
Personally, I think the answer would be for the low-cost producers to look at alternative methods of financing the additional production, so they could preserve their cash for other things, and then do what the Emirates and Saudi Arabia have begun to do with pipelines, saying we don't have to put money in, we can actually monetize some of this. You could begin to do that with production, not by inviting the majors in. I think that's most unlikely, and saying, bring us your technology. They have the technology. That technology, I mean, Saudi Aramco is one of the most sophisticated and advanced technical companies in the world. It doesn't need that technology from the outside, but it needs finance. And I think one could look at ways, I'm not a banker, but I'm sure there are ways that you could get at relatively low rates funding for those investments. That's the kind of, that's the answer to the first question. And now I've forgotten what the second question was.
The impact on, or should we continue? I come back to the first one. The second question was of this more stable, more predictable, more low price environment, the impact on alternative fuels in the energy transition.
I think frankly, you can, well, not forget about it, but the technology that you mentioned, I mean, I'm on the advisory board of Envision Energy, a very creative Chinese renewable energy company. And golly, you look at what's happening on battery storage, consideration of hydrogen, green hydrogen. I mean, what people don't realize, if you have wind energy, wind energy will always be so-called constrained. And that is free energy. You can put it into storage at no cost. So you can make hydrogen. The problem with making hydrogen is that the energy is expensive. But at intervals from all forms of renewable energy, you have free energy, surplus energy, which can be stored. Can be stored in batteries, but batteries are messy things. They take a lot of mining and so on, good for the mining industry. But hydrogen, and I think the international oil industry and the national oil industry should really focus on hydrogen and hydrogen analogs like ammonia.
In a way, like associated gas that you have here.
Yeah. Yes, exactly. You're right. Surplus renewable energy is like associated gas.
Don't say that too loudly.
It used to be free.
People may not like to hear that, but back to question one, isn't
there? Good idea. I hadn't thought of that.
Something good comes out even of interviews sometimes. Back to question one.
Chairman of Envision Energy, he'll love it. He normally refers to me as he used to refer to me as a representative of the dinosaurs, but actually he's changed his mind. He now calls me a representative of the elephants because he's very smart. He realizes that the international oil industry has this massive capacity the cash flow from their existing, they have in trading, etc., they have skills which will, I believe, allow some of them to make the transition very well, but not all of them. Fortunately, they're going to be few casualties.
So here's another thought, connecting the first question, which was, about which you answered with the problem of the producers to secure financing, and the second, which is the energy transition. Wouldn't it be, you said that it's unlikely that Saudi Arabia's and UAE's and perhaps Russia's of this world would invite in the big private majors, and they have the technology anyway, but wouldn't it be much closer to suppose that they would align with consuming countries, in particular with countries where consumption is also mediated at least through governments, big Asian countries?
Well,
it sort of completely changed the picture. We would sit in Europe, say, and all the supplies would be no longer coming from IOCs or Western kind of companies, but from stale suppliers.
Yeah, it would be nice. Then you'd need somebody like me running the world to organize it. I think it's most unlikely to happen. It's the dream. If you will remember, for the many years when Ali Naimi was oil minister of Saudi Arabia,
the central banker of oil.
Ali always used to talk about the consumer-producer dialogue and how we needed to get together and come up with a rational oil price, something that was acceptable to everyone. And well, it didn't really happen. It came close to happening. The next step would have been to go to rational production, but I just can't see it happening. It's a nice idea, but I just don't.
Luckily, that part is not even run by you, but by demand and supply.
Yeah.
I have one final question, which I think is which troubles me. Yeah, it's the last one, and I have difficulties understanding it. This is what you said about low-cost producers, about with the investment bump, COVID bump or not, the environment we are moving to when oil demand plateaus or peaks seems to be so easy to understand and clear that even I share it and understand it. Why is it that the whole industry seems to be not willing to look at this? You said they don't want to talk about peak oil demand, but it's much worse. They don't want to talk about the very serious consequences of peak oil demand. Why is that? Why is there this head in the sand thing?
Well, I don't know that there's really a head in the sand. I think the international companies are scrambling to see how, as was mentioned in the previous session, how you can make money out of renewable energy, where the returns are lower, but they come in a consistent pattern, more like LNG. So I think they're putting a lot of effort into that. So I don't think it's that they're not looking at it, but they're looking at a different part of the picture. Maybe they are looking at it and saying what I say, look, can we really compete with these low-cost producers? The bit we haven't talked about, and we don't have time to talk about, is the geopolitical bit, because we would need a bit of a rational world with people respecting other areas of the world and accepting that there was an interdependency. And unfortunately, we've been moving away from that.
Yeah, hopefully not forever. You want to give it 1 minute? We get into trouble with
I think we're in trouble already.
I certainly don't think we have time to get into geopolitics on this session.
All right, that's one for next time then. Thank you very much. It was hugely appreciated, and as always,
thanks,
thank you very much.
They say Diala, they say back to you, no?
Thank you very much, Christof, for that, and thank you to Sir Mark Moody-Stuart, as always, for joining us. Thank you very much.